economic data has begun to roll over to some extent in certain areas. The housing issue that we've been pointing to in our work is come to the fore. Europe has obviously been slowing quite a bit. The ECB obviously just ended QE. And I think the Fed has the feeling that it needs to give the ECB a little bit of headroom because European PMIs in particular have started to roll over in France.
So why raise? You said have to, and your choice.
Yeah.
Like, I have to get more sleep.
Yes,
but I get up at 2:45 in the morning every day.
I should say.
Do you think that's the right move?
Yes, I think that is the right move.
But why raise rates at all then?
Well, I think the situation went from Fed funds being, I think, at about 78% about 3 weeks ago, now probably closer to 60%. So the expectation for the markets was that the Fed was going to raise rates, almost certainly. And above 80%, the Fed tends to raise rates. Now, certainly, Fed funds futures has given the Fed some headway not to raise rates. That said, I think Chairman Powell has messaged very strongly that they're going to raise rates, and by not raising rates, it would send a very negative signal. So optically, it would look pretty bad if the Fed decided not to raise rates, having signaled fairly clearly it was going to do so.
Okay, if the majority of market participants, such as yourself, believe that we'll get a rate hike, but then it'll be dovish in the first half of the year, the equity markets have not responded. So people are, if they're hoping that that's going to give some kind of a bounce, we're already predicting that.
Yeah.
So where's the bounce?
Yeah, we certainly haven't gotten it yet, and we've been wrong. I've expected something of a Santa Claus rally.
I appreciate the honesty, Peter, but by the way, get in line because a lot of people have been wrong.
Yeah, well, we've also, though more strategically, been correct in sort of calling for caution mid-year this year. And we started with our concern around actually emerging markets on higher developed market rates. Emerging markets are about 70% of global growth right now, and so with emerging markets having to hike to protect their currencies, global growth is likely to slow. So that was our first concern. Then there was housing. Then there was Europe. And frankly, now the credit markets are of concern. The loan market is extended in our view. It's as large as it's been in any late cycle rally. And I think any cracks in the credit markets, we've got a problem.
So we're going to do something on oil in just a couple of moments about that because we always tell people that it's not an oil story.
Right.
It's a debt story. How big is the debt threat to the overall stock market right now?
Well, specifically for energy companies, it is a problem because when you look at a lot of E&P producers, even in the Permian, they're still not cash flow positive. And that means that they're relying on the capital markets.
They're definitely not cash flow positive at $46.
No, they certainly aren't. And even 50 to 55, it's arguable that they're not cash flow positive. And so if the capital markets roll over, a lot of those guys are going to start to face real issues.